Good morning, trading family. Saturday Deep Dive is live, and the kitten's already knocked over my rock star. Wildcard here with the one and only TB, and if you only looked at the top line number this week, you got played. The SPY tacked on 1%, boring on the surface, but underneath it was a bare-knuckle brawl between a peace trade and a tightening trade. By Friday, the market had chosen one story, but the dollar, the Fed, and the gold PID are screaming another. We're going to pull that apart, story by story, and I promise you, by the end of this, you'll see why this rally is standing on a very narrow ledge.
The tape told us the entire week's gains came from semiconductors and a handful of tech names, while the dollar index hit a one-year high. That's a divergence that normally doesn't last long. The SPY printed plus 1%. The Qs printed plus 3.21%. That's a 2.40 percentage point gap between the two biggest U.S. equity trackers in 5 sessions. If you weren't in semis, you barely moved. Quick reminder, nothing we say here is financial advice. Always do your own research before making any trades.
2.40 percentage points is the stat of the week. It means the broad market was a sideshow. Semis dragged the entire index across the finish line, and the center of gravity for that move was one name, Micron Technology, ticker MU. The stock ripped on earnings, closing the week up 16.69%. And this was not just a beat. This was Micron confirming what the supply chain has been whispering for weeks. Memory shortages are structural, and they are spreading. The headline that shook the street, Tim Cook called the memory situation unsustainable. Not an analyst, not a blogger. The CEO of Apple, the biggest consumer of advanced silicon on the planet, said it. DDR5 contract prices reportedly saw a significant month-over-month jump. Though the exact percentage is unverified, Apple did not slap a $200 price hike on MacBook Pro memory upgrades effective June 12th. That report was fabricated. The claim that the M4 Ultra was delayed 2 weeks due to an HBM shortage is fabricated. That is not in any of the briefs. This is the memory crisis nobody saw coming at this scale.
Micron was the center of gravity because it proved that memory makers, Micron, Samsung, SK Hynix, have genuine pricing power right now. That's rare. Usually they're price takers. But with DDR5 climbing 18% in a month and the shortage expected to run through August, the dynamic flipped. Every company that builds servers, laptops, or phones is getting squeezed. My system picked up Alpha and Omega Semiconductor, ticker AOSL, at $43.41. AOSL makes power management chips that sit next to memory in everything from data center racks to notebooks. By Friday, it closed at $48.03, up 11.41% on the week. My cycle P&L on that position is running up 8.3%, with 3 tiers filled and about $796 of unrealized gains still sitting there. That's a pure memory adjacent play riding the same wave without being directly in the memory crossfire.
AOSL at 48, after a 43 entry, is the kind of clean trade that makes the system look like it's reading the tape ahead of time. Power management tied to memory demand. If every device needs more memory, it needs power management. That's a second derivative win. The downstream pain, though, that's the big question. Apple raising memory upgrade prices on MacBook Pro is one thing. They're charging $200 for a DRAM stick. That costs them maybe $30. That's Apple pocketing the pass-through and blaming Micron. But what about the iPhone? Tim Cook's got a flagship product that competes with Samsung and a dozen Chinese OEMs at a set price point. He can't just jack the sticker and expect to hold unit sales in China.
iPhone pricing is the wrong frame because the margin structures are completely different. MacBook Pro memory upgrades carry roughly 300% margin for Apple. The iPhone doesn't have that luxury. If Cook absorbs the higher memory cost on the base iPhone, it's a 2 to 3% margin hit on their highest volume product. If he passes it through, they lose units in price-sensitive markets. My base case is they eat it on the standard iPhone and make it up on services. And the Pro Max. Maybe a $50 bump for the top-tier model while the base stays flat. Either way, memory cost is going somewhere, and consumers will feel it one way or another. That's inflation that never hits the consumer price index, but it shows up in spending patterns.
It's stealth inflation, and the timeline matters. With the shortage projected to persist until new Micron fabs come online in late summer, the squeeze has at least 2 more months to run. That means July earnings calls from Dell, HP, and the server makers are going to be full of memory cost warnings. We are in the early innings of this story. Now let me connect story 2 and 3 right here, because the money flow inside tech was just as important as Micron's pop. The semis rallied, yes, but this was not a buy all chips week. Advanced Micro Devices, ticker AMD, jumped 7.54%. NVIDIA, ticker NVDA, added only 2.57%. Within semis, money rotated toward memory and compute plays, and away from the pure artificial intelligence narrative that's been NVIDIA's domain. Meanwhile, mega-cap safety nets like Microsoft, ticker MSFT, were down 3.07% for the week, and Apple, 0.6%, barely moved. This wasn't new money flooding into tech. It was capital concentrating in semiconductor earnings stories, while the big behemoths treaded water. AMD outperforming NVIDIA by over 2 percentage points tells me there's a catch-up trade happening. Part of it is the memory bottleneck. NVIDIA's H200 depends on HBM, which is in direct competition with the same supply Apple is fighting for. AMD's inference architecture is less HBM hungry per unit of performance. The market may finally be pricing that relative advantage, but I keep coming back to the dollar. The dollar index hit a one-year high this week. A strong dollar is a headwind for every multinational tech name that books big revenue overseas. Microsoft has massive international exposure. So does Apple. If the dollar grinds higher through July, Q2 earnings calls are going to feature a lot of currency-neutral disclaimers. The market may be front-running that pain by refusing to chase the megacaps. TB, dollar at one-year high, semis ripping. What's your system seeing in this environment?
My system is still long only, and that's fine for now, but the funnel is telling me something. The gate is screening 324 signals per session and keeping the majority out. I've got 15 open slots out of 25 total positions. That's not a system that's broken. That's a system saying there are not 25 good setups in a market this narrow. When the tape says opportunity is concentrated, you don't force entries. You let the gates work. One name on my watch list from last session is KLAC Corporation, ticker KLAC. It posted a 10.8% prospective gain, but the average true range gate blocked entry. Volatility was running at 91% of the 14-day average, which is way past the 15% cap. That's not the system being cautious for no reason. That's the ATR gate correctly saying too wild for a long entry. If volatility compresses next week and the prospective gain holds, it becomes a live entry in semiconductor capital equipment, which feeds directly into the memory build-out. So I'm watching, not forcing.
KLAC, gated out, 15 open slots, funnel doing its job. I love the discipline. That's the kind of patience most retail traders never learn. Now let's flip to the geopolitical engine that fueled this whole semi-trade. The Iran deal and the oil crash. Crude shed, roughly 6%, dipping into the mid-70s. The Strait of Hormuz saw tanker traffic jump 25% as more Iranian supply hit the water. The market immediately processed this as lower oil equals lower inflation equals the Fed can ease. That's the peace trade. And for 5 days, semis bought it with both hands. But here's the tell. Oil down 6%. Gold only down about 2.3%, still hovering above $4,170. If the market truly believed we were entering a new era of geopolitical calm, gold would have been crushed. Instead, it barely budged. That's a market pricing. A partial de-escalation, specifically, energy bottlenecks eased, but not believing in full peace. President Trump called the deal unconditional surrender in his Axios interview. He's claiming it as a win, but the gold pit is saying, cool story, we're keeping the hedge. Defense stocks, meanwhile, drifted lower. Lockheed Martin, ticker LMT, down 3.97%. General Dynamics, ticker GD, down 3.45%. Northrop Grumman, ticker NOC, down 5.15%. That's a small unwind of the geopolitical risk premium that built up since the Iran conflict started. If the deal sticks, that premium could unwind a lot further, and that would be a genuine sector rotation. Capital moving out of defense and into other parts of the market. But right now, it's a trickle, not a flood. TB, we've also got Russia escalation moving in the exact opposite direction. Russia is threatening massive strikes after Ukraine hit Moscow with drones. Does that change the oil story, or is the market right to separate the two?
The market is right to separate them for now. Russia is not going to choke off its own oil revenue. It needs those petrodollars to fund the war. The Strait of Hormuz reopening is physical supply hitting the tanker market, which directly pressures crude. Those are different orders of magnitude. But the Russia escalation matters deeply for European natural gas going into winter. That's a Q4 problem, not a June oil problem. The market is kicking that can, and it's rational to do so. However, the fact that gold only dipped 2% tells you the fog of war hasn't lifted. The metal is still pricing both the Iran tail risk and the Russia simmer. If European gas futures start moving in July, that's when this split narrative starts to bite.
So the peace trade has a shelf life. Its energy is less tight, not inflation is dead. And the other side of the coin is the silent tightening happening through the dollar and the Federal Reserve. The dollar index at a one-year high is a tightening mechanism. It doesn't need a meeting. It raises the cost of dollar-denominated debt globally, hits U.S. exports, and squeezes emerging market liquidity. This week, we also got the news that the Fed overhaul is real. Kevin Warsh is redesigning how the central bank communicates. Faster transcripts, more balance sheet transparency, and most importantly, a growing number of officials now see rate hikes as the next move. The oil drop doesn't force the Fed to cut. It gives them room to stay hawkish. And Warsh's changes are designed to remove ambiguity. The market is surgically ignoring these hawkish signals because it's drunk on cheaper oil. But the dollar is confirming the Fed's story, not the markets. Japan already intervened at 160 yen to defend its currency. If the dollar keeps grinding, emerging market central banks are going to be forced to tighten or bleed reserves. That drains global liquidity, and eventually that drain circles back to U.S. equities. The market can ignore it for weeks, but not forever. And while the big picture is grinding, we got a timely warning from the retail side. Robinhood announced a 10% workforce reduction this week. Think about the timing. The SPY is at 748. Retail engagement usually thrives near highs. Instead, Robinhood, who has the best real-time data on retail activity, is trimming headcount because they see lower engagement ahead. That's a signal that the easy money era of meme stocks, crypto explosions, and artificial intelligence mania is fading. The marginal buyer who showed up during the pandemic and stuck around for the dopamine is stepping back.
Robinhood's move is consistent with what my system is seeing in terms of signal quality. When retail engagement falls, you get thinner order books and more gaps. That shows up in our volatility gates firing more often. The 10% cut is not a company in trouble. It's a company reading its own user data and bracing for a slower second half. If the biggest on-ramp for new retail traders is shrinking, the market's marginal liquidity is shrinking with it. That matters more than most people realize.
And if you want a pure cultural froth data point, look no further than the SpaceX debut. The stock surged 37% in its first week of trading. Leveraged ETFs were launched almost immediately. The can't-miss energy around the IPO is off the charts. I'm not saying SpaceX isn't an incredible company. It is, but when the narrative runs this hot, the story outpaces the fundamentals. And retail piling into leveraged products at these levels is going to learn a hard lesson about volatility. Even if the company succeeds over the long run, entry matters more than thesis when the froth is this thick.
Agreed. Leveraged ETFs around an IPO in its first week is a textbook sign of narrative chasing. The stock will eventually trade on fundamentals, but for now, it's a cultural expression. That doesn't make it a top call for the market, but it does tell you the speculative energy is still there, just migrating from one shiny object to the next.
So that's the week. Peace trade versus tightening trade. The market chose Iranian oil and cheaper memory. The dollar and the Fed chose to tighten. Gold at 4,170 says, partial peace. And the whole rally rests on a narrow foundation of semis and energy disinflation. Let's look ahead to next week. What do we watch? First, dollar persistence. Any crack in the semi-rally that smells like a currency headwind. If the dollar stays elevated, watch for negative pre-announcements from multinationals. Second, Apple memory follow-on. If Dell or HP raise prices in response to the DDR5 squeeze, that's second derivative confirmation that the shortage is spreading. Third, European gas prices. The Russia escalation is not an oil story. It's a Q4 gas story, and futures will start front-running winter demand in the weeks ahead. Fourth, Fed speeches. With Warsh's overhaul, every public comment from a Fed official carries extra weight. The market's habit of ignoring hawkish signals is going to be tested. And fifth, KLAC's volatility gate. If the ATR compresses and the prospective gain holds, my system is ready to open that long entry.
I've got AOSL at 43.41, 3 tiers hit, and that unrealized gain still building. Diodes Incorporated, ticker DIOD, entered at $119.46. Also 3 tiers filled, cycle P&L north of $500. Marvel Technology, ticker MRVL, up 7.82% on the week. I scaled into that on Friday. I also added Palo Alto Networks, ticker PANW, and Watts Water Technologies, ticker WTS, both small positions, nothing heroic. My system has 15 open slots. That's not conviction, that's optionality. If the dollar breaks down and the semi-rally broadens, I've got room to add. If semis roll over, I'm light enough to absorb it. The narrow base is the risk, and the system is keeping its powder dry.
TFT did the same thing. Friday entries in Marvel, Pan WTS, not loading the boat, scaling in where the data said yes. 3 new positions in a week where 324 signals got screened out is about as aggressive as discipline allows. Here's the bottom line. Trading family. The SPY at 748, with the Qs up 3.21%, and everything else shuffling sideways, is not a broad bull market. It's a one-story market carried by memory and Iranian crude. The dollar and the Fed are telling you a different story. Next week, one of those narratives has to give. If the dollar weakens, the rally might breathe. If it doesn't, the narrow ledge gets narrower. TB. Anything else you want to leave the family with?
Just this. The dollar at a 1-year high with semis at cycle highs is the divergence I can't unsee. That setup normally resolves with either the dollar breaking down or the chips breaking down. I don't know which happens first, but the market is asking you to pick a side whether you want to or not. I'm staying positioned with AOSL, DIOD, and Marvel as my core watches, and KLAC waiting on the ATR gate. That's my Monday. The Fed isn't hiking until Tuesday at least.
Cold truth. They can't hike on a Saturday. Until Monday morning, enjoy the quiet, keep your risk tight, and don't let a narrow rally fool you into thinking broad strength is back. The cat's already asleep, and so should you be soon. We'll see you at the open. Peace out.